All right, so I think the topic of question was point of releases, how to identify a point of release, and also how to identify point of release failure, and sort of the symmetric nature of how when the point of release fails, that that level can act as, maybe if you're looking at it as support, then it's going to act as resistance after that level is lost. And
Yes.
you can essentially, there's an example right here, right? So if we zoom in on this, this is in the context of more of a high time frame order flow, right? So you have, you can see it on the daily chart, right? Obviously, we have this high time frame order flow, and if you marked off the resistances here, here, and also this one right here, you can see that like price, it comes down, hits support at these levels, and it does a little bit of a dead cat bounce, but it never like does the full retracement. Same thing here, although it mounts a little bit more of a rally, it still doesn't reach its resistance. And same type of deal here too. You have a bounce, but not your retracement. So that's a situation where you kind of have to keep your eye on it when it's happening in real time. Otherwise, you'll have your orders too far up, and if you're not aware of the nature of the order flow, then this is a time when you want to be playing closer to the market, right? And not demanding so deep retracement, but you also want to frame that in context when you are taking your trades, right? So we're on the daily time frame. We saw what was happening there, but then so if we go down to a 4 hour, right? Um, you do have this break of structure on the 4 hour, but it's still within the context of the larger time frame downtrend on the daily. Anyway, so we have this point of release here, right? And we can mark off these highs and just see pretty obviously that they do act as support after broken. So you got these this high here comes up, comes down. This high gets broken, comes up, comes down. I mean, this is pretty classic shit right here. Um, I think we've talked before about how the clean break typically tends to line up with the 618. So if you draw a 618 here, right, comes down, hits that level, comes up. Not always. I mean, here, uh, it doesn't. If you drew a 618 here, it wouldn't do the same thing. But just the clean break levels tend to, uh, line up with the 618. I guess in this situation, the point of release is so far down in the consolidation that's kind of why. When you have your point of release closer to the clean break, that's when you get the 618 lining up with the clean break. But anyway, you've got your clean break here, your point of release. So if I were looking at this, I would be looking at this as the point of release. And everybody has a different definition for it, or like where it actually starts. And I don't think any definition is wrong. I think the best explanation is a simple explanation, right? If you um, if it looks like the nature of the market's changing and volatility is picking up at a certain level and volume's coming in, well, it's probably a point of release. So it's going to be different on whatever time frame you look at. But since we're looking at a 4 hour chart, we have this level here. Um, so this is a good example of what I'm talking about, right? We were talking about the difference between a vertical accumulation and sort of an apex formation. So you have your breakout here, and so this is a market structure shift, right? And we can go back and let me just play this out just for the sake of being thorough. What's going on here? just to identify this high time frame level we're looking at. Right, so price came down to this level here, right? You have, so some people would, have this, the top of this weekly candle marked off. You might mark off the closes down here, but a lot of people would be looking at this weekly trading range as support, or this level in general to act as support, and we see that it did act as support. And forgive me for switching time frames so quick, but just trying to put this frame of reference here. Just, you have your high time frame level over here, price comes down, and you have the so price hits it, bounces, comes down, does a little bit of a downtrend, but I wouldn't get too cavalier here because of the idea that in the context of being at a high time frame level, right? I wouldn't be looking for this to just drop out of the sky from here, right? It did put in a little bit of a rally, and it broke market structure. So anyway, in that frame, you want to see a little bit of retracement above these levels, and then you see the retracement above this high, and that's when the dynamic really starts to change, right? Because so here you have this impulsive price move that creates, if you want to call it a price gap or an inefficiency in the market, and then you come down to the high time frame level. Yeah, technically it's a downtrend. I mean, you're not wrong in calling it a downtrend, but it's at a high time frame level. Then it comes up, fills this gap, or runs just above these highs, right? Knocks the stops out, and it's there's multiple levels right there. But anyway, this is to tie into kind of how it's different for a vertical accumulation and an apex formation. So here you have this run of these stops, which is the key distinction in my mind. Right, had this not happened, or had price ran up and closed above there, then it's a lot different, right? It's the fact that it ran up, took those stops out, came back in the range. That's the red flag, right? That's the warning shot. That, okay, this might be an apex reversal pattern. We got to keep an eye out for that, right? So and then again, in the context of the higher time frame trend, right? Yeah, we have a 4-hour point of release here, but if the higher time frame takes over and that fails, then we get the symmetric swing that we were talking about, or we were looking for, right? So if a lot of people maybe you're looking at this level of support, well, you can see that it really didn't offer the support you're looking for. It just, but it did offer the symmetric behavior in the sense that when the level was lost, obviously you great shorting opportunities there multiple times. And so, yeah, you see the symmetrical pattern play out essentially on every single time frame. Just the high time frames, they just take longer to play out. But let's go through here and see if we can find any more. Yeah, so here's a good example. Right, you have this one right here. Again, I would identify this as a point of release, just because the market sort of is moving in a volatile fashion, comes down, and volatility starts to dry up, right? At least relative to previous volatility, so it's tapering off, and it really starts to move into this this low liquidity state here, right, where volatility is really drying up here in the middle of the consolidation. And then you get this impulsive price move. And another key point is above area of very significant liquidity, right? And because not only is this a high right here, but it's a swing high because it's surrounded by lower highs, right? So it's a very, very significant area of liquidity. So you get a low liquidity state. Liquidity or volatility expands, runs the liquidity above there, and then you get the same pattern playing out on like the lower time frames, right? So it goes up, runs above there, and then if you went onto like 15-minute chart, you could see the same exact pattern here, right there, right? And then it does the same thing as it did here. It runs above these highs on a 15-minute chart. It would look the same. It runs up above these highs and then slams back down in the range, and then there you get your breaker right there. Uh, so then this level is no longer really relevant because it's already. The reason why it's no longer relevant is because the liquidity has been ran, right? So the market has already sought liquidity above this high. It's taken it, so it's no longer there. We have to look at other levels.
And do you put an expiration time on breakers? Like, what if that were to go on for 3 times as long before it actually got back up there?
Yeah, I mean that's a good question. I mean so essentially, yeah, I don't think there's a time limit on it, right? To put it in context, like this level, liquidity still rests above this level, right? So if and it hasn't been run yet. So if price were to run back above 69,000, and the key point is that if it ran above 69,000 and then slammed back down, well then you don't necessarily have that formation starting, but you sort of have the etchings of it, right? So if that were to happen, then you want to be on guard. It's like, oh, okay, fuck, like that would be brutal, man, because that would be a lot of distribution patterns. They happen in 3 drives, right? So you had let's go back to see if I can change time frame successfully. Maybe. Oh, here we go. Yeah, so that is a real thing to look out for, and I think a really good point that you mentioned. You can see this 3 drive pattern playing out. Here, right? Comes up, expansion volatility, then 1 drive. You should get your first drive, then your second drive, then your third drive. The market breaks structure, then runs into a bearish 618, and then gives up the ghost essentially. And here you basically the same pattern, although not quite as clear. The third drive doesn't make a lower low, right? But this is more of a Wyckoff accumulation, but you get the same idea, right? 1 drive down, another major drive, creating your second swing, and then a third drive. So that pattern could be playing out on the high time frames, and that would be fucking brutal. If you get your third drive up above these levels, slam down, but not only slam down, but comes down, breaks market structure, and then you get your bear market. That would be fucking brutal. But we are traders, so we want to keep that on our radar because we don't get to choose what the market does. But anyway, yeah, going back to this area, so your 4-hour expansion, you get your same 15-minute expansion. Liquidity's been ran over there, then gets run above these highs, comes down. You can use these lows as a invalidation, or not invalidation, but resistance. And these breakers, or a lot of people call this like a bearish breaker block because this ran liquidity and then come down, violate these lows. They have a lot of staying power. To answer your question, like this, it doesn't seem like price revisited a while ago or a while after, but if you were waiting for this, these are 4-hour candles. It would feel like price took a long time to get back to that level. But you can see that doesn't have any effect on how powerful it is.
Right? Yeah.
But yeah, we identified the point of release here, and we can see that when that area provides a very good. People talk about like a break of market structure. And this is a very good way to identify breaks of market structure. I would say the best way to do it, right? Because you're framing things in the context of liquidity, right? So what low created an impulsive price move to run liquidity, right? Okay, well then if that low is lost, that is a bad sign. And so I would use this level as identifying a break of market structure. In fact, I was long here expecting all-time highs, and I used this level a little bit as invalidation. I also use this level as well. But you can see how like when a level is lost, it it provides very good symmetrical price action. And this is kind of the area where once you get your break of market structure, people are in a little bit of disbelief, right? And this is where people, are maybe not managing their positions like they should be. They're losing positions, but also provides a opportunity. The market oscillates around this area where it gives you a very good opportunity to enter a trade. If you see, so you have this, it's sort of like an inflection point, right? So if price comes, so you see price comes down here, right? And it's not really at this level, right? So price comes down on a wick basis and violates it, which, isn't, I wouldn't necessarily view this as a break of structure. Now, this is an important topic because it's very nuanced. I would still have a stop here, right? And I would still manage as if I had some long based on this level and I was entering around this level, or I would still have a stop below this low, managing a good deal of risk, just because uh, you don't know what can happen, and it could price could just trade down through it. So you do want to manage a great deal of risk on that. And so price would come down, say maybe stop me out for, say I'm using 50% managed on a static stop. Well, then maybe I re-enter, right? Because price didn't just blow through, right? It it stopped me out, but you also get this long wick buying pressure. So of course we know how it played out uh, in hindsight, but a lot of times if you see price come down below a low and then get bid up like this, that could be a stop run, right? And then we could use um, this level here as risk management. Just because like if you see price come down below a level and it runs a level and it gets bid up like that, um, you don't necessarily know that it's a stop run at that point, right? But you do know that if it runs this low, uh, it's game over. But so essentially, you could see, maybe so you really get your confirmation when this low gets taken out here, and then you really get your ideal entry up here, if that makes sense. Um, and this is a good example of like how you want to trade around the inflection points, right? Maintaining a little bit of a neutral bias, and you want to trade with very low risk, right? I mean, like a very low risk is a percentage of your account size, because it just makes it easier to have the mental flexibility to operate on both sides of an inflection point. So, say you're taking a long here based on some bullish concept, you get taken out. Well, if you're not risking much, then you don't really, it doesn't bother you. You can, if you get to see that price turning around the inflection point, then you just re-enter the other direction. And that's the whole idea, is you really want to base trades around these inflection points. It's as opposed to like the middle of the range or some similar area like that. You can see like when this point of release gets lost on the big picture, you know, uh, that's when volatility really starts to pick up again. You get your break of structure, a little bit of complacency. Um, price oscillates on the high time frames, of course, and then really starts to pick up. But these break of market structures are really great times to enter trades for sure. Let me see if I can find another example of this. Okay, yeah, here's a pretty good example. You have, maybe you're identifying point of release here, right? So price comes up. Maybe you're looking at this as a break of market structure. So you say, okay, well, I'm going to trade this point of release down here. and price breaks through, right?